Welcome back to Smart Stock Sam, the channel where we cut through the noise and trade the numbers, not the hype. Today's breakdown is the one everybody has been asking for: why so much retail money is fixated on that $2 level in AMC options, and the crucial piece of the puzzle that most of those traders are completely overlooking. Before we get into the mechanics, here is the roadmap for today. We are going to walk through why AMC's fundamentals look like a slow-motion collision, why Wall Street just dumped the stock, and why that exact same broken balance sheet is quietly creating a rare, dilution-free trading window over the next several weeks. Then, we will break down the exact options wall that market makers want to defend, and I will hand you a complete trade plan, entry, targets, and stop-loss included. So, if you have ever wondered whether AMC is a buy, a sell, or a trap, stick around, because by the end of this video, you will know exactly which one it is, and more importantly, when. And stay until the end, because I am also going to show you the one thing that would actually have to happen for this whole setup to fall apart, and honestly, the odds of that happening in the next few weeks are close to zero. Right now, AMC is living two completely different lives at the same time. On one side, the fundamental picture looks brutal. As of July 5th, 2026, the stock sits at $1.89, a staggering drop of 33.68% since July of 2025. That is not a dip, that is a collapse. The company is deep in what I would call dilution fatigue, constantly restructuring its balance sheet, while retail shareholders quietly absorb the damage. But here is where it gets interesting, and here is a question worth asking. Could a company this fundamentally broken actually offer a clean, low-risk trade in the short term? On paper, the odds of that sound almost negligible, and yet recent filings point to exactly that. A confirmed 45-day cooling-off period now blocks AMC from launching any new equity offerings. That means for the next several weeks, the single biggest fear hanging over this stock, surprise dilution, is temporarily off the table. And when that fear disappears, even briefly, technicals and options positioning take over the wheel completely. Ask yourself honestly, how often does a company this troubled hand traders a clean, temporary window like this? Almost never, which is exactly why this one is worth paying attention to. That 45-day window sounds like a gift for short-term traders, but stick around, because there is a brutal cash burn number coming up that explains exactly why Wall Street punished this stock so badly just last week. Let's talk about how AMC actually bought itself this breathing room. The company recently completed a total capital raise of $350 million. That came in two pieces: a $150 million at the market offering sold directly into the public markets, followed almost immediately by a $200 million registered direct offering to institutional buyers. Where did that cash go? The lion's share, $125.5 million, went straight toward retiring AMC's 6.125% senior subordinated notes. That single move pushed the company's major debt wall out from 2027 all the way to 2029, buying critical survival runway. Sounds smart, right? Here's the catch. The market punished this balance sheet repair instantly, with shares cratering 19% in the pre-market the moment the news hit. Wall Street's message was simple and brutal. The price of survival was too high. Could management have found a cheaper way to buy this runway? Maybe, but with the debt wall they were facing, the realistic chances of a painless fix were slim to none. Now, if we step away from the spreadsheets and walk into an actual movie theater, the story takes a surprising turn. Operationally, AMC is genuinely having a good year. CEO Adam Aron is projecting a record post-pandemic box office, with domestic revenue expected to land anywhere from $500 million to $1.2 billion above 2025 levels, powered largely by the fat margins on IMAX and Dolby Premium formats. On top of that, AMC just locked in a newly negotiated 49-day theatrical exclusivity window with Netflix, a real win for its content pipeline. And culturally, this company still owns the room. Adam Aron proved that when he casually leaked minute-by-minute details of the Taylor Swift and Travis Kelce wedding at Madison Square Garden. Unconventional, sure, but it kept AMC riding the same cultural wave it caught with the Eras Tour movie. It is a reminder that whatever happens to the balance sheet, this brand still knows how to stay in the conversation. These operational wins sound fantastic on paper, but none of it matters if the actual bank account tells a different story. So let's open it up. Peek inside the first quarter 2026 financial health dashboard, and the illusion of a full recovery falls apart fast. Yes, revenue looks impressive at $1,045 million, with a healthy 67% gross margin. But top-line revenue is vanity, bottom-line profit is sanity, and AMC posted a net loss of $117.1 million. Worse, free cash flow sat at negative $174.7 million, with operating cash flow at negative $128.5 million. You simply cannot run an empire while bleeding that kind of cash every single quarter, and the capital structure backs that up. AMC is carrying $7.34 billion in long-term debt, $9.61 billion in total liabilities, and a jaw-dropping negative $1.93 billion in shareholder equity. In plain English, they owe far more than they own. Could a single strong quarter erase that hole overnight? Realistically, the chances of that are next to nothing, which is exactly why the long-term picture stays so difficult. So with a balance sheet that looks like a slow-motion car crash, how are the biggest institutions on Wall Street actually positioning themselves? You might expect everyone to be running for the exits together, but the real answer is far more divided than that. Institutions currently hold 140,020,660 shares, just 15.69% of the float. Pentwater Capital Management leads the pack with a massive 9.99% stake, more than 63 million shares. Discovery Capital Management is not far behind at an 8% stake. But here is where it gets uncomfortable. Vanguard Group, one of the most conservative, patient asset managers in the world, executed a full 100% liquidation of its position as of March 2026. They did not trim, they walked away completely, and there is more legal noise brewing. A class action lawsuit filed by Bronstein, Goertz, and Grossman alleges AMC used an undisclosed loophole during the APE to common stock conversion to exclude APE holders from a special dividend, adding fresh legal overhead onto an already strained company. When a manager as cautious as Vanguard walks away completely, it is worth asking what they saw, even if the odds of a single clean answer are low. If the smart money is split and the lawyers are circling, what does that mean for what this stock is actually worth? Let's look at what the analysts say. Wall Street's consensus lands squarely on a hold rating with an average price target of just $1.96. Premium valuation models are not much rosier. Simply, Wall Street pegs fair value at $2.16, suggesting only a slight undervaluation at today's price. B. Riley is a touch more optimistic at $2.25, but even they admit the box office recovery story is already baked into the share price. Here is the number that should really grab your attention, though. Screeners are flagging AMC's sluggish 2.3% annualized revenue growth against a bloated forward EV to EBITDA multiple of 13.9 times. Paying 13 times earnings for a company barely growing 2% a year simply does not add up for a value investor. Could analysts be missing something huge here? It happens, but it is rare, and the setup does not suggest this is one of those times. So, does all of this add up to an obvious long-term buy? Honestly, the chances of that being true right now are close to negligible, and here is exactly why. I want to be as direct as possible. AMC is fundamentally uninvestable for long-term portfolios at this moment, for three clear reasons. First, dilution has become their survival currency. Retiring those 2027 notes avoided a near-term crisis, but constant equity issuance permanently shrinks your slice of the company every single time. Second, the capital structure is genuinely broken, negative $174.7 million in quarterly free cash flow stacked against negative $1.93 billion in equity is not a temporary rough patch, it is structural decay. Third, we need a real re-entry trigger. Before this changes, long-term investors should stay on the sidelines until AMC posts consecutive quarters of positive free cash flow without leaning on new share issuances to get there. Until that happens, this is dead money for anyone thinking buy and hold. Could that trigger arrive sooner than expected? It is possible, but based on everything we just walked through, I would not bet on it happening soon. But remember how we opened this video? I told you there was a mathematically clean trade hiding in plain sight, and it all begins on July 6th. Welcome to the Catalyst Pivot. That 45-day cooling-off period we mentioned earlier temporarily removes the threat of surprise dilution, opening what I am calling a dilution-free safe zone, running from July 6th through the middle of August. During this window, fundamental fear takes a back seat. Price action stops being driven by balance sheet stress or surprise press releases and instead gets dictated almost entirely by technical channel dynamics and options pinning. In other words, for a few weeks, the algorithms and the market makers are effectively driving the bus. To actually trade that window, we need to set the fundamentals aside completely and look purely at what the chart is telling us. Right now, AMC's technical posture snapshot reads strong sell overall. Shares are trading at $1.89, pinned underneath heavy moving average resistance. The 50-day moving average sits overhead at $1.96, while the massive 200-day moving average acts as a hard ceiling near $2.02. Momentum-wise, the 14-day RSI reads 43.87, still bearish but clearly stabilizing, a sign the aggressive selling has paused. The MACD, meanwhile, sits at negative 0.024, confirming that negative momentum technically still has the upper hand. Now, with momentum this negative, plenty of retail traders will tell you a massive short squeeze has to be right around the corner. Let's actually check the data and pop that theory. Across social media, you will hear endless chatter about the mother of all short squeezes coming for AMC. The data tells a very different story. Current short interest sits at just 6.99%, roughly 58,160,000 shares. Off-exchange short volume is elevated at 44.66%, but the days to cover ratio is a thin 1.52. The number that really matters here is the borrow fee, sitting at a razor-thin 0.68%. Shorts are paying next to nothing to hold their positions, meaning there is essentially no financial pressure forcing them to cover. The honest takeaway, a short squeeze here, is highly unlikely in the near term. So our trade plan has to rely on real technical channel mechanics and genuine support levels, not a fantasy parabolic squeeze. If you were hoping today's video would confirm a squeeze story, I get it. But the honest math says the chances of that happening right now are practically negligible. If a squeeze is not driving this stock, who actually is? To answer that, we need to look at the invisible hand quietly steering price action, the options market. This is where things get genuinely fascinating. Looking at the July 17th expiration, which currently shows a heavy 90.05% call volume, retail traders have stacked a massive overhead wall at the $3 call strike with 86,444 contracts and at the $2 call strike with 76,435 contracts. Down below, put support is comparatively thin, just 20,048 contracts at the $2 put strike and 10,658 at the $1.50 put strike. Here is the mechanic worth remembering. Market makers are financially incentivized to pin this stock right near that $2 level heading into mid-July expiration. Why? Because doing so lets more than 76,000 call contracts expire completely worthless, letting market makers keep every dollar of retail premium instead of paying it out. Could price blow straight through that wall instead? Given how much premium is sitting there waiting to be defended, the odds strongly favor the wall holding, not breaking. So if market makers want to drag this price toward $2 like a magnet, how do we actually build a trade around that? That brings us to the actual trade setup, the speculative long bounce. The idea is simple. We range trade this dilution-free window by riding the bounce off support straight up into that options pinning magnet at $2. We already know the ceiling. That $2 options wall is our absolute cap. Our floor sits at $1.84, which lines up perfectly with the classic S2 and Fibonacci S2 and S3 pivot support zones. This entire trade is simply about playing the bounce between that floor and that ceiling. Let's break this down into exact numbers so you know precisely where to get in, where to take profit, and where to protect yourself if it goes wrong. Here is your complete trade architecture. Step 1. Entry. You are targeting a buy zone between $1.84 and $1.86, right off that recent low and the established pivot support. Step 2. Profit targets. Your first target is $1.96, lining up with the 50-day moving average resistance. Your second target is $2 flat, and this one is a mandatory full exit. Do not get greedy here. That options wall will act like a brick ceiling. Step 3. Risk management. Your hard stop loss sits at $1.79, placed just below the classic S3 pivot of $1.83. If price breaks below that stop, the technical support has failed, the trade thesis is dead, and you exit to protect your capital. Zoom all the way out, and your success trading AMC depends entirely on which timeline you are actually trading. Let's lock in the final takeaways. On the macro picture, the rule is simple: do not hold. AMC remains fundamentally uninvestable for long-term portfolios. Dilution is their survival mechanism, and you should not build a long-term position until they post consecutive quarters of positive free cash flow without new capital raises. On the micro picture, the rule is execute the channel. Trade this 45-day cooling-off window, respect that $2 option ceiling as your mandatory exit, and stick to your $1.79 stop loss without exception. Now, a quick but important note before we wrap up. Everything in this video is for educational and informational purposes only. This is not personalized financial advice, and I am not a licensed financial advisor. Markets are unpredictable. Stocks like AMC carry significant risk, and you should always do your own research or speak with a licensed professional before putting real money on the line. That is how you trade the data instead of the emotion, and that is exactly what we do here on Smart Stock Sam, every single video. If this breakdown helped you see AMC more clearly, hit that like button. And if you are not subscribed yet, now is the time, because we break down a new ticker like this every single week. I want to hear from you too. If AMC's 45-day dilution-free window closes and management goes right back to diluting shareholders in mid-August, would you still trust this stock enough to trade it again? Drop your answer in the comments. I read every single one. If this video genuinely saved you time or helped your trading, consider sending a super thanks using YouTube's built-in support feature. It directly fuels more research like this. And if you want to go even deeper, our channel membership is officially open, and it comes with real perks. Early access to every trade setup before it goes public, priority replies to your questions, and custom analysis on tickers you personally request. If you are serious about leveling up your investing and trading, that membership is where the real edge lives. Until next time, this has been Smart Stock Sam, trade smart, and I will see you in the next one.